We continue to expect a strong global recovery this year amid significant fiscal support, accommodative monetary policy, diminishing lockdowns, and accelerating vaccinations. As the title of our latest cyclical outlook essay suggested, investors should be prepared for an inflation head fake in the next several months. While we expect a temporary bump in inflation in the near term, we believe inflation generally will remain below central bank targets over the next 1 to 2 years. However, markets may remain focused on inflation risk, contributing to elevated volatility. We expect GDP growth in China to rebound to above 8% in 2021 from last year's low base, with consumption taking the lead. As policy normalization starts and global manufacturing catches up, the strong recovery momentum from last year will likely fade. However, manufacturing investment should strengthen as business sentiment improves and the country refocuses on industry upgrading and supply chain security. On the other hand, infrastructure and housing fixed asset investment may moderate due to fiscal tapering and property market tightening. The government has pledged no sharp policy turns in an effort to foster a solid recovery. However, risk prevention is regaining policymakers' attention. We therefore expect a moderation in credit growth and the fiscal deficit following the spike in 2020, with policy rates and the reserve requirement ratio kept unchanged through 2021. The downside risk in the near term includes US-China frictions, a sluggish recovery in consumption, and export underperformance as global competition resumes. The volatility in rates and foreign exchange may increase given the evolving inflation focus and strength in the US growth recovery. We aim to limit duration exposure to Asia markets that exhibit high correlation to the US Treasury market, and in this context, there is still value in China onshore rates exposure, which despite the outperformance this year, it is still pricing in some degree of monetary policy tightening that may not materialize. In terms of currencies, with the view that the Fed will be slow to raise rates, and we expect further modest US dollar depreciation over time. Some tactical exposure to Asia emerging market currencies in a more controlled manner would be appropriate, or via pair trades given the dynamics within Asia. Asia credit valuations remain attractive overall, while both US and European credit spreads are near pre-COVID tights. Asia credit spreads have not as meaningfully recovered and remain wide relative to their historical averages. We continue to see a number of compelling bottoms-up opportunities. From a sector perspective, we are overweight more cyclical sectors that will benefit from accelerating vaccinations, such as commodities, travel, and entertainment. We remain favorable towards the Indian renewable energy sector, which has strong structural policy support and demand from ESG-focused investors and increased premium for green bonds. Lastly, we still see value in select China real estate credits. The bottom-up research and selection is key, as government policy and idiosyncratic risk will drive performance divergence and create both winners and losers in this sector.